Next, we're going to go to the gentleman from Tennessee, Mr. Rose, for 5 minutes.
I want to thank Chairman McHenry and thank you to Director Chopra for being here today. Director Chopra, last month the New York Times ran an article with a headline calling you, quote, Wall Street's most hated regulator. And that bankers believe that you are a regulator gone rogue. Do you agree with the characterization that you are Wall Street's most hated regulator and a regulator gone rogue?
Certainly not, but you'll have to ask them. We try and make sure that all of our work is really with the public interest in mind, including honest financial institutions.
Thank you for that. I want to say this to you because I feel this very strongly about all of our federal regulators, is that, in my view, your first responsibility is to help those who you regulate comply with the regulations, and that your entire approach to that regulated community that you deal with should be to empower, enable, inform, educate, facilitate their compliance with the regulations that are intended to protect the consumers of this country. Do you agree with that observation?
Yes, and in fact, we spend much more of our energy on supervision, and most of the issues are not dealt with in litigation or enforcement actions. In many cases, they are when they're serious or repeat offenses, but we do take that as examiners looking at where there are issues and being constructive about how it can be fixed.
So I worry then a little bit. I know earlier in your remarks you highlighted the amount of fines that you've recovered from the regulated community. And so
Restitution.
I just would caution you that I don't think that's the objective. I don't think that's what we ought to be measuring your success by. So I think actually compliance with a regulated community that understands what they're supposed to be doing to protect consumers, that's the goal. And that's what I'd like to hear, is measures that affirm the agency's understanding, the Bureau's understanding.
Well, and just to comment on that, we have really focused on repeat offenders and others. We're not trying to target with gotcha actions. I saw that at the Federal Trade Commission, where that agency had a history of targeting small businesses, strong-arming them into settlements. We just are taking a very different approach.
Well, thank you. Director Chopra has already come up today. I'm sure you're aware, of course, of the FDIC Inspector General starting an investigation into the extremely serious workplace misconduct allegations first raised by the Wall Street Journal. As a board member of the FDIC, will you commit to fully cooperating with any requests made by the FDIC Inspector General regarding their investigation?
Oh, of course, and in fact, we cooperate with all sorts of inquiries on this.
Thank you. And will you commit to fully cooperating with congressional investigations into workplace misconduct allegations at the FDIC, including promptly turning over any requested information and documents?
Well, as always, we will work with you to accommodate your requests. Obviously, it's another agency. We have the CFPB, but you're right, I'm a board member, so we will do our best to accommodate that.
Thank you. And Director Chopra, have you ever been investigated for workplace misconduct?
I've never been a target of an investigation. Of course, where there has been issues, there's lots of IG, other investigations. We always cooperate, but I've never been a target of one.
Do you believe that consumers should have the financial freedom to make their own financial choices as long as loan terms are clearly disclosed?
Yeah, I think that's right. I think we want consumers to have lots of choice and to be able to compare one with the other. I think in the digital economy, there is new issues about how they can present certain information, so-called dark patterns. But yeah, we want to give consumers that informed choice.
Thank you. And as our time winds down here, would you help to explain how you and the Bureau are ensuring that the costs of regulations and other CFPB actions do not outweigh any potential benefit, especially since those costs, of course, will likely be passed on ultimately to the consumer?
Well, we never want to do something that makes the public work worse off. I think your colleague asked me a question about, when there's benefits Congress had passed the Debt Bondage Repair Act, which the CFPB implemented. That's about a human trafficking survivor getting their life back. It is sometimes hard to put a dollar figure on it, but we do our best in the required analyses in those rules.
Thank you very much, and I yield back.
Gentleman yields back. We now go to the gentleman from North Carolina, Mr. Nickel, for 5 minutes.
Thank you very much. I want to thank Chairman McHenry and Ranking Member Waters for their work on these issues. It's great to see you, Director Chopra. My colleague from Tennessee said that the reference the article where you're the most hated regulator on Wall Street. I was just on Wall Street yesterday. I think definitely you are not the most hated. I can feel pretty confident about that. Don't know if that's much of a consolation prize, but I want to thank
Not a
you.
popularity contest,
Yes.
but yeah.
And 25 of these, I know it's been, when you get down to the final row here of Democrats, it's been a while. So thank you for your testimony and being here. I want to thank you for the work you and your colleagues at the Bureau do daily to protect consumers. Democrat or Republican, all of our constituents rely on the CFPB to protect them from financial harm. In fact, over 82% of Americans want the Bureau to continue doing its job. I think that's a good record of success. And earlier, I heard from some of my Republican colleagues, was glad to hear their, voicing words of encouragement and support for open banking. I want to talk a little bit about open banking. I'm glad the CFPB proposed the personal financial data rights rule last month to accelerate the shift towards open banking. Open banking would give consumers the right to control their financial data, which is long overdue. As an example, if one of my constituents has a checking account at a bank but is receiving bad service, high fees, under the current system, they'd have to jump through a significant amount of hoops to, quote unquote, break up with that bank and move their data to another financial services company, whether it's a bank or fintech. They'd likely lose some of their data along the way, and spend countless hours trying to piece it all together as they make that shift. But open banking will change this, make life easier for consumers, drive down costs, and promote financial inclusion. Can you share your thoughts on how open banking is transforming the financial landscape for consumers in the U.S.?
Yeah, I think the more we can give people the ability not to just solely be judged by a 3-digit score, but also their financial history, being able to give that data to be able to get a better term, to avoid illegal conduct, to really have more of a driver's seat. I think this is really a way to make banking a way that puts consumers have a wider range of options for them. And I think smaller entities are really going to be able to compete more easily with the big players this way. Rather than being locked in with one provider, local institutions or startups will have more of a chance to win on the merits.
Yeah, and under this proposed rule, the CFPB would rely on a separate standard-setting organization to establish the technical standards and certifications for consumer permission sharing. Given that this organization would be a separate entity from the CFPB and not subject to its oversight, how would you ensure that all parties have a seat at the table and that this arrangement doesn't result in anti-competitive behavior while also meeting its standard-setting obligations in a timely manner?
It's a huge concern to make sure that they're not a small set of actors who get to dictate, in an anti-competitive way. So we would have oversight under our proposed rule. The CFPB would have to recognize the standard-setting body, and pursuant to longstanding guidance, that body would need to be inclusive of all perspectives. It can't just be the incumbents, or it can't just be the fintechs. It really has to have everybody. So we're collecting comment on that now, but that is going to be a big piece to determine how open banking accelerates.
Thanks so much. And just in the remaining time, I want to just touch on credit repair scams. I've been working on legislation in a bipartisan way to finally stop credit repair scams. And I know we've talked about this at my office. Appreciate your work and your leadership here. These companies market themselves to financially distressed consumers, falsely promising to increase credit scores while charging exorbitant fees and monthly subscription services that can cost thousands of dollars but yield few positive results. While the Bureau took enforcement action against one of the largest credit repair organizations earlier this year, are you concerned that these scams will continue by new organizations, especially as household debt increases?
Yeah, I'm also worried about how they might be targeted using very sensitive information about people, particularly on social media, but not exclusively. So we're trying to look at how people can actually navigate ways to address their debt issues without ending up worse off in the process.
Thanks so much, and I yield back.
Gentleman yields back. We now go to the gentleman from Wisconsin, Mr. Stile, for 5 minutes.
Thank you very much, Mr. Chairman. Thank you for being here, Director Chopra. I think we're discussing really important topics. Let me go back to your opening statement, if I can, for just a minute. In your opening statement, you noted that credit card debt is increasing now north of $1 trillion. Auto loans are increasing north of $1.6 trillion. Mortgages have increased dramatically. The median mortgage in the United States over the course of 3 years went from $1,200 to $2,400. That's significant. It's a major concern. The driver of that I think should be noted is largely the inflationary policies put in place by the Biden administration, in particular, reckless spending, war on energy, including paying people not to work after the pandemic. And so as we look at the drivers of increasing debt for Americans, I would encourage my colleagues on the left side of the aisle to join us to work to bring down inflation. That's outside your wheelhouse, but I wanted to put that out there because I think it's a really important point to your earlier points in your opening remarks. Let me jump into earned wage access, which gives individuals access to wages that they earned, improving the connection between pay and work in a more timely manner. I think a great opportunity that's out there. You commented in the press that CFPB is re-examining the 2020 guidance that maintained that EWA was not a credit product. Can you give me an update as to when you expect the review to be completed?
So I'm hoping we can be able to answer more of the questions that we've been getting in the next few months. And specifically, there
So
has...
you expect in the next few months that
Yes,
you will
yeah,
that
yeah.
rulemaking process will be concluded?
Well, I think we're going to try and provide additional guidance on it. The original guidance that was provided a few years ago covered a pretty narrow set of circumstances. It's essentially ones that were free. So earned wage advance, earned wage access, some of it is with the employer, some of it is separate from the employer.
There's significant development in the
Significant
product space.
developments
So
in
you're
the
expecting
last
in the
few
next
years.
few months
Yes.
that you'll be coming forward. That as you are going through that process, I'd like you to make sure that we're not reducing consumer access in that space. Let me follow up on my colleague Andy Barr's earlier comment as it related to non-sufficient funds in your review of that. I would echo his comment that I think it's important that these rules are enforced prospectively and not retroactively in light of the previous guidance from CFPB. If I jump to one more topic here, the proposed rule that the Bureau's new supervisory powers, in particular as it relates to digital apps in wallets, to dive into that, you noted in your remarks that consumer complaints is one justification of the proposed rule. And if you could give color as to how much complaints rose and over what period of time.
I can't recall. As part of that rule, we're supposed to look at risk using a multi-factor analysis.
No, I understand. So, but if you could get back to me on the complaints, how they came back.
Yeah.
Do you know, is there a portal at the CFPB that someone would issue a complaint, or do you know how the CFPB would receive those complaints from individuals?
Yes, we receive them through our website, through phone and others. We receive thousands each week.
Okay, and then an analysis is taken into account on how many complaints are resolved, or no?
Well, certainly we look at all of those factors, but with respect to that proposed rule, that's one issue, but there are many, many other reasons for the rationale for that proposal. It really focuses on the consumer payment apps.
No, I understand. I just, in the proposed rule, it's noted that one of the justifications for this is a rise in consumer complaints. If there are consumer complaints, I'd like to know. I think that that's a valid thing that we should be thinking about on this committee. So I'm just looking for some clarity and color as to what the rise in consumer complaints is. And so I understand you don't have that off the top of your head. That's fine. But if you can come back to me on the written record as to what that is in a numerical analysis,
Yeah, if you
appreciate it.
we'll answer questions for the record and we'll provide numbers
Perfect.
of where we.
Let me do one final piece here. Last year when you testified in front of the committee, I asked if your speeches, press releases, and blog posts are reviewed by attorneys. You responded that it's sometimes the case. You were kind of open to the feedback that we had because I think your words have very serious implications for consumers and markets, and I remain concerned that some statements that you have made are more in light of shaming businesses into doing what the agency wants rather than going through a traditional rulemaking process. And so I would just continue to encourage you to engage legal counsel in the review of your posts on blogs or at other locations, because I do think they have market-moving influence, and I'm concerned that that's outside of the functional rulemaking process. And appreciate you being here. Mr. Chairman, I yield back.
Gentleman yields back. We now recognize gentleman from Texas, Mr. Gonzalez, for 5 minutes.
Thank you, Mr. Chairman, and thank you for Director Chopra for being here with us today. Let's talk about medical debt. The state of Texas has the highest rate of uninsured working age adults in the country, in part due to the state government and the governor that refuses to comply with federal law to expand Medicaid. Most of my constituency is severely under or unbanked and do not have the upfront capital to pay for healthcare costs, leaving many with medical debt. The ding on their credit report for medical debt, which is not an accurate measure, as you know, of credit risk, also means it's harder for them to access traditional sources for credit, like bank loans and credit cards. I was excited to learn of the proposal announced in September of this year by the CFPB that would address this issue head on. If this goes into effect, could you outline the steps for CFPB, the steps they would take to ensure their credit-worthy consumers are not unduly prevented from attaining credit or even a job simply because the debt they owe or the debt they owe from a loved one who has gotten sick?
Yeah, thanks for the question. I think really our lodestar on this has been the real challenges of accuracy. And again, I mentioned to your colleagues, it's not like a normal loan. And it's often a bill that is put on your credit report. And you mentioned uninsured, but a lot of the issues are even people with insurance. There's many parties. There's provider, there's facility, there's insurance company, there's patient, there's debt collector, there's credit reporting agency. And over many years, I think there's been consensus that there's extremely limited predictive value of this. And given the inaccuracies, you worry a lot that people, when they're applying for a job or credit, are just paying something that they don't owe. So the big credit reporting conglomerates, they have taken some steps, but we are looking about whether we might propose a rule to address it more directly. And we're currently collecting feedback from small entity representatives on that, and that will inform any proposed rule.
I can't agree with you more, and thank you for these steps you're taking. Also, as you know, in 2012, the CFPB implemented its remittances rule, requiring companies that offer remittances to provide consistent disclosure regarding the price of a transfer before consumers make payments. While the remittances rule created essential protections for millions of immigrants, service members, students, and others who send money to other countries, providers have found ways to get around it. According to consumer and immigration groups, U.S. consumer loses approximately $8.7 billion a year due to hidden fees, or they sometimes change it on their exchange rates and recover it in the other country. In June of 2023, you testified before this committee and recognized this issue, like with my colleague, Mr. Vargas, as stated in the past. He calls them junk fees, which I agree. And they've impacted our constituents who send remittances to their families abroad. The money earned by these hardworking people should not be lost to hidden fees or extra fees, but go to their families. So I ask, what is CFPB doing to protect consumers and ensure hidden fees aren't being folded into exchange markup rates? Is there a plan in place to prevent remittances providers from continuing this practice?
Yeah, so we have taken a number of actions against providers that have egregiously violated the law on this front. But I think there is this question of how will a consumer be able to get a competitively priced remittance? You know, they are paying for it. And when you're looking at multiple levers, you know, the exchange rate, sometimes there's an advertisement where it says free, you know, when it's really not free. That's what we're really focused on, making sure we're seeing if that is working or not. there's a lot of other places where people may have options on sending remittances that they may not even be aware of. So we're looking at all of that.
Yeah, certainly things have improved since the 90s, but the concern is whoever their partners are in the receiving
other side.
country. You're right, and I know for Mexico for sure, they get shortchanged on the exchange rate, and I think that's happening around the world. So thank you for the work you're doing, and we hope that you continue looking into this issue that impacts millions of people here and around the world. Thank you, and I yield back.
Gentleman yields back. Gentleman from South Carolina, Mr. Timmons is now recognized.
Thank you, Mr. Chairman. The CFPB has kicked off a massive rulemaking to revise Regulation V, which implements the Fair Credit Reporting Act. The FCRA and Regulation V set strict guidelines for the credit reporting system, and these guidelines enable our credit economy to function. Thus, changes to this foundation should not be made lightly, nor should they be rushed. Accordingly, I have concerns with the FCRA SBREFA proposal that seeks to designate specific data breaches as FCRA violations. Numerous federal and state laws already mandate data security measures and breach notifications to consumers. Nevertheless, the CFPB seems inclined to introduce a strict liability standard concerning data breaches or unauthorized access to consumer data by third parties. But before I move on, the CFPB had its own data breach impacting 250,000 Americans. Would a strict liability standard be appropriate for the CFPB's own data breach?
Well, just to be clear, we have not proposed a rule. We have been looking at multiple options on data brokers as well as how there may be access to data. But of course, the situation at the CFPB with an insider threat was very, very serious. We did the consumer notifications, and even where we erred on the side of making sure it was clear, we talked to our supervised entities. So in some ways, there was automatic triggers that
How
led
will
us
they be made whole? How will the victims be made whole? If it was a private business or a bank, they would have to pay restitution. The CFPB has hundreds of millions of dollars. Is there any restitution that's going to be offered to these
Well,
victims?
so fortunately, we have no indicia, and it's really based on the type of data that it could be used for any type of identity theft. It didn't include...
Like filing unemployment claims fraudulently?
It didn't include the type of information that could lead to that. But of course, I take your point. It was very serious, and we are taking steps to address it. And with respect to that outline, we're really trying to make sure we're guarding privacy. And I agree with you that actually the credit reporting system is foundational, and we want to be judicious.
Let me ask this. Do you know of any other example of data security and breach notification requirements that are enforced with a strict liability standard?
I do believe that some state laws do have that, but I would need to, I can look it up and answer a question for the record.
Okay, that'd be great. I guess I'm just concerned what impact this standard would have on economic activity. Almost every corner of the financial services industry will tell you that their cybersecurity teams spend more time and money on compliance than on actually keeping their data safe. I think the last thing we need is yet another redundant regulation taking resources away from these entities from providing actual cybersecurity.
And we don't want to do anything redundant, that's for sure.
Well, thank you for that. Director Chopra, it's been reported that the CFPB is readying a proposal focused on bank overdraft fees, and apparently doing so just conveniently right after your appearance on Capitol Hill this week. Is this report accurate, and what are you proposing in that rule?
So we did put on our regulatory agenda many months ago that we'd be looking at overdraft and NSF. We haven't made any decisions on it, but one of the places that we got input on is people wanted some clarity on what the rules would be. There has been guidance documents, there's a number of places, so we're trying to sift through all that and ideally propose something that makes sure that there is not overdraft abuses.
I guess overdraft is a service provided by financial institutions for consumers to manage their finances. I'm curious, given your previous statements today about attempting to foster competition in the banking sector, why do you think it's a good idea for government to set the price for a clearly disclosed service offered to customers in the private sector?
So it's not about setting a price. I think there have been certain places where prices are a safe harbor to avoid some of the cost of compliance. But what we are looking for is for there to be a competitive market. When people are borrowing, we want them to have lots of choices and to be able to get it in a way that is the function of the market.
I guess that's just the free market. If they want to go to a different service provider to get a better rate, they should. I'm just worried that such a rule will merely result in denying overdraft protection for millions of Americans. These are the Americans who need it most. And if we start impacting the free market, I fear that they're not going to be able to have access to overdraft protection. So the people that need it most, their transactions will ultimately be declined. I appreciate the intent, but the outcome will be detrimental to those that you're seeking to protect. So as you consider this issue, just appreciate that the banks are not going to offer overdraft protection if they're not able to charge a fee for it. So with that, Mr. Chairman, I yield back. Thank you.
Gentleman yields back. We now go to the gentleman from New Jersey, Mr. Gottheimer.
Thank you, Mr. Chairman. Hi, Director. While I know that you don't have direct oversight over tolling, you do have oversight over financial institutions, particularly with regard to revenue from exorbitant fees charged to consumers. It has come to my attention that some financial institutions are providing favorable credit terms to New York's Metropolitan Transportation Authority, the MTA, based on enormous and outrageous fees, including a new $23 a day congestion tax just to drive into New York City that will be paid by hardworking families, particularly my constituents in New Jersey. And you're a Jersey guy, so you know about these issues I'm talking about. We're talking about charging nurses, cops, and firefighters, labor, restaurant workers, and other hardworking families $23 a day just to drive into New York City. You understand consumer fairness perhaps better than anyone else in this room. Are you concerned at all that these banks will be making money off of gouging middle-class Americans with exorbitant tolls from their new congestion tax? And will you commit to investigating the revenue that financial institutions are making from this congestion tax?
I actually have not heard this. I'm from outside Philadelphia, but I know my uncle worked for the New York MTA for a long time, but I will look into this and get back to you.
I really appreciate it if you do that. I'd be very grateful, and I'll follow up with you. I'm working with Representative Cartwright on legislation that would require the 6% interest rate cap for loans made to active duty service members to apply to all applicable accounts held by the service member at a particular financial institution. This is an issue I've been following closely, and I know the CFPB released a credit card market report last month that found that many credit card companies are not proactively checking service members' military status to ensure that they receive the benefits they've earned in return for their sacrifices and service to our great nation. What needs to be done to make sure that more credit card companies are proactively checking?
This is a very good point, by the way. With higher interest rates, you have actually a lot more people, including on their mortgage, where the Service Member Civil Relief Act protection is going to kick in. We released some analysis about the low levels of take-up for National Guard and Reserve who were activated. You know, our Service Member Affairs Office and I put out some recommendations on what institutions can do to make sure that they're covering everyone. You know, it is voluntary. We know some are doing it, but I do think there's some good questions about whether it should be required to simply make it go through the process rather than having the service member deal with every single notice.
Right, putting it on
through
them,
that process.
right.
And there is a database. So we can get back to you with some further details on that, but it's a good, worthwhile idea.
Yeah, I would really like to follow up with you on that as well. That would be great. And Director, this committee, as you might know, has recently discussed earned wages access, known as EWA, products which offer individuals the ability to draw money from their paychecks before payday. Several states, such as Maryland and Connecticut, have classified EWA products as credit products. Other states like Nevada and Missouri do not recognize EWA providers as lenders. Director, does the CFPB view EWA products as forms of credit? And if so, does the Bureau have plans to treat this product on a level playing field with other credit products, including by requiring the providers to disclose the cost of credit?
Yeah, so, you know, earned wage, EWA is often a branding term. It can be an earned wage cash advance. It's a cash advance. Sometimes it's through the employer, sometimes it's not. You know, the CFPB a few years ago did issue some guidance that was pretty narrow. It essentially involved free earned wage advance. So we know the market has developed a lot. Of course, you know, federal law still applies, no matter, you know, there's federal and state law. We live with federalism. We are looking, as I mentioned to your colleague, to updating the guidance given all the evolution in the marketplace.
Thank you so much. It's critical that we classify, in my opinion, and govern these products appropriately. I'd like to shift gears quickly to open banking. One of the most prominent consumer protections is protecting consumers from fraud, as you'd agree. And as you know, fraudsters' practices are evolving constantly, and the industry needs to be able to continue to innovate to be more effective in curbing bad actors. I'm concerned the open banking rule as written will hinder critical industry efforts to fight fraud by prohibiting the use of consumer data to develop or improve fraud identification products. Can you please clarify how the proposal permits the development and improvement of anti-fraud tools?
Well, I think what you're referring to is there's limitations on secondary uses of the data. In other words, that's really to prevent fraud. We don't want someone baiting a consumer to hand over their data and say, I'm going to give you an auto loan, when in reality they're using it for all sorts of other purposes. So really the goal is to protect the consumer, to reduce bad actors. I think there are some questions in the notice of proposed rulemaking about how data can be used. We're collecting comment on that. But of course, we do want to make sure that fraud is reduced. Congressman Foster raised the issue of identity verification. There's really a lot to work on this front.
Thank you. I yield back.
Gentleman yields back. Now recognize the gentleman from South Carolina, Mr. Norman, for 5 minutes.
Thank you, Director Chopra, for testifying today. I'm going to move through a couple, and any we can't get through, we'll write a letter if you could just get it to us. One question has come up, has been the funding for CFPB for the Supreme Court. You mentioned that y'all have undertaken a pretty extensive review of expenses trying to cut the cost, I guess, of CFPB. Has that been successful?
Well, I like, just to make sure it's clear, we're always looking at ways to sunset old contracts that are no longer in use, reduce waste. We try our best to constantly be doing that and find more ways to get value out of every dollar with our procurement. So I have seen places where we are making inroads on it. At the same time, we have to execute our mission, and that requires expenditure.
Well, when you look at what the history is, I think what CFPB has done, they can issue a one-page letter to the Federal Reserve and fund up to 12% of the Federal Reserve expenses. In 2021, it was $717 million for fiscal year 21, and then in 2022, it was $734 million. Has 2023 seen an increase from the $734 million?
Yeah, I believe so. And in fact, we have to consider a number of factors. And of course, a big driver is wages and compensation. That's our biggest piece.
But you'd fair to say it's gone up.
Oh, yeah, it has gone up. The projections are based on, I don't think they're out of line with, other banking regulators. I think in some cases it's lower.
Well, I think it was brought up about, we voted on doing away with the CFPB. I was one of the 148 that voted to do away with it because of funding. Congress, you ought to have some type of oversight. In any governmental agency that can just submit a one-page letter and get it funded, I think is unfair to the taxpayer. Change the topics, the Fair Credit Reporting Act, I think the CFPB is removed or in favor of removing all medical debt from the credit report. Is that right?
No, we haven't proposed it yet, but we're collecting feedback from small entity representatives on that. And I think, again, it's interesting because it's not like another loan, and then inaccuracies and dispute rates on them are extremely high compared to other products. And we also see that, FICO, others.
You wouldn't be in favor of taking it off the
Oh, we haven't proposed it yet, but that is one serious consideration that we're collecting.
What's your opinion of it? Real briefly, because I want to get to know.
Well, I think actually based on the data over the past 10 years, I do think that the harms associated with inaccurate medical debt reporting cause a nightmare for people.
So you would take it off?
Relative to the benefits. Well, I kind of want to see how it all works. The difference is, medical debt, I think we think of it separately from like the medical bills that you don't apply for in advance as opposed to the medical loans.
Let me ask you this, you've got a small business review panel. Who have you dealt with, or I guess who have you gotten opinions of? Has it been for medical providers? Have you interviewed them?
Yeah, so we have, in terms of the panel, we'll need to get you more information on who's on it, but I've personally talked to a number of medical professionals, including medical debt collectors, who are inside the hospitals, inside
You've met with them to get their opinion of this?
Yeah, and I think,
And I'll get a letter if you could just respond who you've gotten with.
Well, and we can even share with you some conferences where we've given presentations. What's interesting is many of the hospitals actually don't send it to credit reporting. So there's a lot of heterogeneity in the practices. So
I'm out of time.
Okay, sorry.
If you get information to us. Now, on Regulation F, where consumers can consent to receive accounts receivables via text, you have certain companies that are blacklisting, that are not sending text to, even though the consumer wants them to. Like an Operation Choke Point. Do you think this is right?
Wait, say that again.
If a consumer asks for the accounts receivables to be received, the information on it by text, some companies just are not doing that.
Well, let us know about it. I will say the regulation doesn't require that debt collectors provide information by text. It just allows them if that's a choice, but we're happy to follow up
Okay,
with you on that.
thank you so much. I appreciate it.
Gentleman's time has expired. We now go to the gentleman from Massachusetts, Mr. Lynch.
Thank you, Mr. Chairman. Welcome, Director Chopra. Good to see you again. Thank you for all your good work. I wanted to ask you about the proposed rulemaking that was announced in November. So we've got a bunch of these larger fintech firms that are using digital wallets, and in a way, they're sort of blurring the line between regular commerce and banking. And so I know that the original announcement was that you were going to look at some of these larger firms and require them, because they are in a good part of the banking business, require them to report as we require small banks and credit unions. I wanted to just get some of your thinking behind that, and how big does a fintech firm need to be before they would come under this reporting, which I think is appropriate for some of these larger and busier firms.
It's interesting. You have a lot of non-banks, particularly with apps that are transmitting, I think it's now trillions of dollars globally. In many ways, they look a lot like what we see emerging in China, where large tech firms have a lot of ability to collect data, move payments. Yeah. So we've proposed bringing some of those firms and subjecting them to supervision. We already have enforcement authority over them.
Right.
We think the supervision actually makes sure there's a level playing field between the banks that are doing it and the non-banks. There's a number of issues, fraud, privacy. I think there's going to be a lot of value in that. We're collecting comment on the specific threshold, but we estimate it's about 1 or 2 dozen that could come under.
So you just had a case. I was reading that one of your enforcement cases recently was Innova. Was that the name of it?
Yes, Innova.
They actually went in and took money out of their customers' accounts. So obviously we've got that.
Yeah, can I just share, Congressman,
Yeah, please.
that we have a lot of situations where people are able to get information about a customer and then they can just grab the money. And there's lots of issues that impacts. So making sure that our payment system, has a lot of fidelity. This is so important to the lowest income people in our country, because if a wrongful debit in their account can send them into a tailspin.
Right, and there's credit rating issues there based on much of that difficulty. What about, I know one of my colleagues raised an issue earlier today about, I think it was Citibank, and there was a discrimination issue there with Armenian-sounding names, I guess.
Well, it was actually names particularly that ended in YAN.
Yeah.
And IAN.
I've got a big Armenian population in my district, so I'm quite familiar with that.
Those are obviously going to impact the Armenian community.
Where does that come from, though? I mean, do you have any sense of?
Well, as we investigated the enforcement action, they had determined that they actually filed false reports to those borrowers as to why they were declined. And they ostensibly said it was to detect, prevent fraud. But, we allege, and I think provided very strong evidence that that was prohibited national origin discrimination. We have laws on the books that don't allow it to say, you type of people.
These are Armenian Americans, though, aren't they?
Yes.
Yeah, so in this country. I was just curious what the underpinnings of what the motivation might have been there, if anything, during your investigation.
Yeah, we can share more, but there was, they had detected, they were excluding people from the Glendale, California area, which has a very high concentration of Armenian Americans, as well as people with that last name suffix.
Okay, well, maybe we can talk offline about that. I do appreciate your good work, however, and how readily available you've been to members of this committee. I think it's commendable, the way you've handled your responsibilities. Thank you, and I yield back.
Gentleman yields back. We now go to the gentleman from Pennsylvania, Mr. Muser, for 5 minutes.
Thank you, Chairman. Thank you, Director. Good seeing you. And I, too, believe that your work is focused on improving situations. But I can't help but have a number of questions, and maybe you can help clear some things up for me. Your mission at CFPB, part of it anyway, is to aim to make consumer financial markets work for consumers, responsible providers, so both, and the economy as a whole. We protect consumers from unfair, deceptive, or abusive practices and take action against companies that break the law. However, there are many in the banking and business community that think that the CFPB is guilty of practices that are unfair and perhaps abusive, and that there's tremendous overreach, and that very often, rather than the bright line concept, there's ideology over specific rules. And this isn't just from one, set of, resources. I mean, it's from large banks, small banks, super large banks, super regionals, small, $1 billion banks, $10 billion banks. I put out a text a little while ago to a few, hey, give me some of your thoughts on CFPB. My phone's blowing up with negative comments. Like, for instance, the 1071, it will impose significant costs on banks, costs that will be felt most acutely by small community banks that will negatively affect their small business customers. From another group, this was from a group, the proposed rule scope is unnecessarily far-reaching. It would exempt very few community banks, define small businesses so broadly as to include tens of thousands of large businesses, and require institutions to collect and report data on numerous data points in addition to the congressionally required data points. Next one, the CFPB 1071 rule would create onerous reporting requirements for both small business owners and the financial institutions. Here's one as well. The biggest issue with the CFPB, and I know this person personally, small bank, $1 billion probably, is the regulations restrict banks from residential lending, limiting options for borrowers, forcing community banks to lend to more commercial customers. Okay, so I'll leave it to you. How is this working? Why, everybody, what a great job is being done. Okay, I'd love to see a great job being done. I want consumers to be protected. I don't want bad characters to be able to play out. And so that should be a good thing. But the fulfillment of all of this needs to have a feel that there is some sort of synergy or at least improvement in line with what is best for the economy as a whole. So that's a somewhat general question, Director, but I'll ask you to comment on some of those comments I read off.
Well, it is true that when regulators are doing their job, we won't always be the most popular when it comes to those who we enforce the laws for, when it comes to detecting where there are potential crimes. I get it. Many of the things you mentioned are things that Congress enacted in order.
We're talking about 90% of the banking community here on who I'm referring to.
Well, I will tell you, I hear from a lot of financial providers who are eager for us to crack down on some of the abuses that we see, because you know what? They've got to compete with these people. They've got to be the ones competing online often with these misrepresentations. So we take all the feedback. I've met, I think, with every state banker association,
so adding
representing people on this committee, maybe even more. We want to make sure that the law-abiding businesses are not disadvantaged by those that cheat.
I
And
understand
again,
that, but
it's
you're
not a
not
popularity
receiving the
contest.
feedback that, and you said to me in the last hearing that you would reach out more and have a more of a comprehensive, relationship, or even get feedback from those who are knocking themselves out. You went to the Wharton School of Business. I know you got to believe in capitalism to an extent. It's a competitive marketplace. They're trying to win customers. They're not trying to abuse their customers. But even with that would be ridiculous, because they would go out of business. That's how it works. The 81 total data points, the questions that were added. Last time we spoke, you said it's not 81. I forget what you said. It's like 18 or something. No, it is in fact 81.
It is not 81. If you are asked a multiple choice question of what state do you live in, that is not 50 questions.
You
That is one.
expanded upon
No, I mean,
the
we keep
congressionally
having this-
authorized questions that you were given. Why is sexual orientation something that a bank is supposed to ask
Because in the
business or
statute,
consumer?
there are requirements on
Not that.
demographic.
That's not in the statute.
Well, the Supreme Court has ruled that discrimination.
It's an
based on
overreach.
sex-
It's not in the congressional statute. I yield back, Mr. Chairman.
Gentleman yields back. We now go to the gentleman from New York, Mr. Torres, for 5 minutes.
It's always a pleasure to see you, Director, and I have found you to be as impressively communicative and responsive as any agency head in the federal government. So thank you for your commitment to protecting working people from predatory fees. My first question is about remittances. I represent a district in the Bronx where families have to pay excessive fees in order to transfer their own money to loved ones abroad. And the high fees and long delays of the existing remittance system imposes a hardship on the lowest income Americans, particularly immigrants. And as a nation of immigrants, as you know, the United States is by far the largest source of remittances, $72 billion in 2021 alone. In your view, what can and should be done to create a better, cheaper, and faster remittance system for the most vulnerable among us?
Well, there's so much. One, we need to make sure that the existing providers are not engaged in bait and switch, that they're telling the truth about how much it's cost and they're not hiding things with junk fees. But I think with digitization, we've also got to think more broadly. Lots of you have constituents who send money abroad. I see how in big commercial contexts, there are often agreements between large banks, between central banks. We should be thinking about the plumbing of the financial system so that people can send things cheaply and safely. And I think that requires the attention of us, the Federal Reserve Board, and many others.
I have a question about blockchain and stablecoin in the context of remittances. Blockchain can enable real-time transactions, stablecoin can digitize the dollar. Do you believe that the combination of blockchain and stablecoin, if properly regulated, has the potential to play a role in creating a better, cheaper, and faster remittance system?
Yeah, we've seen that actually some digital apps and other products have been able to actually help people send money to a family member who's in a very remote area. They may not actually live near a bank or a place that has a remittance provider, and are sometimes able to use that in ways that really kind of bridge so much divide. Now, on the underlying technology, obviously it's complicated. We want to make sure that it is well regulated, that there's not fraud, that people have a fair sense of what it is, but I'm totally open to working with all of you as you think through that.
Much has been said about AI. AI is the most revolutionary technology of our time. I have found the discourse about AI to be pessimistic to the point of apocalyptic. And so I'm curious, what do you see not only as the greatest risk, but also the greatest reward of AI when it comes to consumer protection in the field of financial services?
Yeah, so look, in some ways, AI is not totally new. It's really advanced computational methods. There's lots of good ways to prevent fraud. There may be ways in which you could detect some sort of error in your finances, help you automatically dispute something. There's certainly going to be consumer use cases. I think a little bit of where we should be cautious is throwing it out into the world and just kind of seeing what happens. I think we should be thoughtful about how are the different use cases, generative AI and copying of biometric data, lending and how it would work in algorithms. So we should be precise on it, but I think there are opportunities. I'm not apocalyptic, but I want to make sure we're being cautious.
Is CFPB exploring how to harness the power of AI to enhance enforcement?
Yeah, I think we are always looking at more advanced tools on how we analyze our complaint data, other data to detect and deter wrongdoing, just as other law enforcement does.
On the subject of crypto regulation, the agencies that typically come to mind are CFTC and SEC. What is, could, or should be the role of CFPB in the field of crypto regulation?
Yeah, so it's less about the underlying technology and more about the use case. There has not been a huge intersection, but certainly if you have a stable coin that very rapidly scales on one of these payment apps, like another consumer payment, that's certainly a consumer use case there. So that's a real place that we are watching it. But most of the other uses that we see in the financial markets are indeed outside of consumer financial products.
And so what are your existing authorities with respect to stablecoin regulation?
So the relevant ones that come up a lot are the Electronic Fund Transfer Act, which is kind of fraud, movement of digital money, privacy, the Gramm-Leach-Bliley Act privacy provisions, but there's some other ones that get implicated as well.
I see my time has expired. Thank you for your service.
Thank you, sir.
Gentleman yields back. I'm going to recognize myself for 5 minutes. I'd like to insert a letter into the record from the Consumer Bankers Association commenting on today's hearing. And Director Chopra, your recent Fair Credit Reporting Act proposal on data brokers and consumer data, it doesn't include a fraud exemption when an entity is using data to help verify a customer's identity. The treatment of credit heater data described in the outline would prohibit financial institutions from using it for the essential anti-fraud purposes for what it's used for today, I guess. As you know, identity verification and consideration for credit worthiness are two distinct actions with their own legal frameworks, KYC laws, and the FCRA. Have you consulted with prudential regulators and FinCEN to understand how capturing identity verification activities under the FCRA may impede compliance with the Know Your Customer requirements if in fact the data is considered a consumer report?
Yeah, so just to be clear, we have not put forth a proposed rule. One of the places that we know there is a huge desire for fraudsters to take control over is really that identity-related data. So we're trying to think of all the ways in which we can protect it, but not undermine, really what banks and lenders are legitimately trying to do for financial services. So to answer your question, yes, certainly we have discussions with the Treasury, FinCEN, others on a wide range of issues. And I can assure you that your message here is loud. I hear it loud and clear. We don't want to do anything that undermines some of the legitimate financial company work. And I think it also goes back to something Mr. Foster said about identity verification. I really think all of us need to work on what is the future of identity verification, because it can open up a lot of questions for harms in the country if we don't have a robust one.
Very good. Let me shift here. A small pediatrician office in Sheboygan, Wisconsin, has estimated that the CFPB's proposal to remove medical debt from credit reports will lead to a revenue decrease by 11% or $11,000. I worry that further reducing the information that lenders have on borrowers, it's just going to result in higher costs and higher rates for all. Is there any way that CFPB has studied this or, tried to figure out what the impact would be on individual, medical clinics, I guess?
Yeah, so I think we're thinking about it in two different contexts. The medical provider, facilities, and then separately, the lenders. So you raised two parts. What will be the impact for them? What would be the impact on, the credit reporting system? On the second part, there's actually been a move away because of the limited predicted value of medical bills on credit reporting. We've talked to a number in the medical industry. Many of them actually don't put it on credit reports, and actually most small players, I believe, they don't. So we're really looking at all of that. And again, we have not proposed a rule. We're going through the process of collecting input in advance of proposing. We'll then have public comment before we pursue it. But I will tell you, I am concerned about widespread inaccuracies in medical debt credit reporting.
Very good. One more on privacy. We've heard from many Wisconsin bankers in discussions with their small business customers about the 1071 reporting requirements, which have been discussed many times today. They're concerned about the public release of the data. I mean, we're talking about, villages of 1,000 people. And some counties actually would find themselves, I think, in a similar situation. It would be very easy for somebody to sit down and kind of figure out who this is or which family this is. Considering how important privacy is to the Bureau, why wouldn't you first publish the results of the re-identification study and then take comments as required by APA to balance the risks and the benefits of the disclosure?
So we're pretty far away from any publication on it. And let me just share with you that compared to mortgage data under the Home Mortgage Disclosure Act, the data here is going to be totally different. Like you said, there may only be one type of small business type in an area. So we are going to look at that. I'll take that suggestion about how we might proceed with that, but we're many years off.
Very good. I yield back, and at this time, we recognize the gentlewoman from Colorado, Ms. Pedersen.
Thank you, Mr. Chairman, and great to see you, Director Chopra. It's wonderful to have you. You do a very good job being in the hot seat. Well, being last, all my questions have been asked, but one thing that I've thought a lot about sitting through this is what it was like to live in poverty, what it was like when I was younger, having multiple jobs while I worked my way through college, putting myself through school, being, just one financial emergency away from being unable to pay for rent and put a roof over my head. And when I think about those life experiences that are so important to have when you're sitting in these seats, about understanding what people are struggling with every day and how important your work is in fighting for regular people who these junk fees can really have an enormous impact, or zombie debt. And so I just want to thank you for the work that you do every day and your team. And when I think about zombie debt in particular, I was reflecting on when I was younger in high school, and I had something, I had to go to the emergency room, I paid for it. Later on, when I was qualifying to buy a house, it showed up again.
Credit report.
Well, no, but I paid for it, but then it was sold off. So zombie debt, where it's paid, years later, you have no proof. Oftentimes lose that, and they know that, so they sell it off knowing that is likely. And so many people in my life have dealt with this. And I remember being a young person and feeling like there was no accountability, nowhere to go. And so I know recently you had, CFPB had a field hearing on this issue around zombie mortgages specifically, and wanted to see how you all are thinking about what to do about zombie mortgages and how they're targeting seniors, but also if there are gaps that Congress should consider in addressing.
Yeah. Thank you for that. And let me just share, one of the things that's really great about the work we do is we actually get to hear directly from thousands of people a day about exactly those situations and how it affects them and really what they need to do to how we can fix things for them. So on zombie mortgages, there was, and we think this is quite targeted in a few metro areas, but maybe nationwide, second mortgages that were considered satisfied, but that have reemerged and are targeting people sitting on home equity, often seniors. Zombie debt, more broadly, of things that just keep popping up over and over again, and the consumer is often put in a place to prove they've paid it, even though, it may be long ago. I think there's a lot of ways in which the credit report, too, is used to coerce people into paying this debt parking. So we do use our authorities under the Fair Debt Collection Practices Act and Fair Credit Reporting Act, but I think it's worthwhile to think if we need any sort of enhancements to it in order to make sure that this type of, what I see often as fraud, doesn't recur.
Great, thank you for that. And I know that, you're trying to change behavior by doubling down on going after junk fees. And I don't know if you want to talk quickly about how you all are identifying junk fees, and then also what you're seeing with behavior changing from businesses and what that means for consumers.
Yeah, I think we've seen a number of very large banks who engaged in some hyper-aggressive illegal practices. We reached 2 major enforcement actions. Wells Fargo, Regions Bank. It was pretty bad conduct. We have seen, though, a pretty big shift in the market of moving away from some of these junk fees. And I think we've tried to go in other industries to see where are they charging something that really is for nothing. I mean, I mentioned earlier to your colleagues, we found a paper statement fee that they didn't print or mail. So we have to make sure that this is just not another way to cheat people. And we're very proud of that work, and I think it's made the difference of billions of dollars.
Great. With 20 seconds remaining, anything else you want to add? I know that there are a lot of topics.
Well, I just hope, I know I've known some of you now for many years, and I do hope that there's some things that we all see eye to eye on. Protecting data, privacy, junk fees. I think there's a lot we can do to really row in the same direction. So I appreciate all of you who have met with me to really help inform our work.
Thank you very much. I yield back.
Gentlewoman's time has expired. We now go to the gentleman from New York, Mr. Garbarino.
Thank you, Mr. Chairman. Director, it's good to see you. It's great you just asked about junk fees because one of my colleagues asked about it before as well, and I'm trying to get an actual answer. Are fees for negative business transactions, late fees, overdraft fees that are part of the contractual services provided by financial institutions to customers who sign up for products such as credit cards and checking accounts, would you consider those junk fees? Would you consider, if someone signs up for a credit card or a bank account, a late fee or an overdraft fee?
Well, some of it is how it's assessed. So we, for example, I mentioned those 2 enforcement actions. Sometimes they assessed it by mixing around the transactions. Sometimes they didn't even deliver it. So the analysis.
I guess if I agree. If they don't deliver, if there's no overdraft and they charge an overdraft fee, that's a problem. But if the statement says if you're late with your payment, or if the contract says if you're late with your payment, we're charging your late fee, or if you overdraft and it's a legitimate overdraft, we're charging an overdraft fee. Are those fees?
I think I'm in agreement. I'm in
junk?
agreement with the spirit of what you're saying. The issue is that it can't override federal law, so there can't be deception around it. There's other congressional prohibitions. And again, like Congresswoman Pedersen said, I do want to recognize the industry has made some real moves on this, which I think are commendable.
I get that, but late fees and overdraft fees aren't blatantly junk fees.
Well, it depends on how
I
they're
agree,
being
but
employed. Yeah. I take your point. Look, the way we define junk fees are ones that are not subject to the competitive process, really are hidden, or are sometimes for things that are not even services or not even provided.
I get that.
So we try and focus on where it's illegal, fraudulent, but there's other places where you have a lot of honest banks out there competing on the upfront price, and then others building a business model off of something.
I understand that. My point is if a contract says if you're late paying your credit card statement and somebody's a week late, we're going to charge you $25. It's pretty straightforward.
Yeah, well, it also has to
so I would
comply
think-
with federal law.
Of course, yes. Yeah. All right, I want to move to something else. I want to talk about an issue that it's related to the Fair Credit Reporting Act proposal on the data brokers. From what I understand, the CFPB is considering significant changes to the FCRA, including broadening the scope of what constitutes a consumer reporting agency to basically any entity that compiles and makes available consumer financial information, whether or not it's used for eligibility decisions. Currently, the Bureau's authority is limited to regulations that are necessary and appropriate to carry out the objectives of the FCRA. However, the recent FCRA SBRIFA includes broad and novel definition of data broker, which seems to contradict decades of regulatory guidance, case law, and congressional intent. It also creates conflicts with the KYC requirements. Given those contradictions,
where in the CFPB's limited rulemaking authority does it have the ability to create the new definition of data broker?
Yeah, so I don't agree with what you just shared there. One of the pieces of input you all have given us is, try and avoid where you can regulation by enforcement. There's a lot of companies out there that meet the definition and activities of a consumer reporting agency. Yes, we could go and litigate it, bring enforcement actions. The goal is in some ways to provide some clarity about the business model of a consumer reporting agency, which now you have a lot of different firms that are collecting these dossiers on us, and to create a level playing field around it. You mentioned the issue of KYC fraud. As I shared with Congressman Fitzgerald, the chair, we are taking that very seriously and looking at all the uses of it. But I think we need to be careful about data brokers often compiling information about Americans and often selling our most sensitive data to bad actors overseas, including to defraud people.
I understand, but I just want to make sure that where though. So you think you already have the authority. CFPB already has the authority to do all this with the new data.
Yeah, because we have to make sure that we're administering the Fair Credit Reporting Act, and if you look at even the legislative history.
So under the Fair Credit, that you believe you have it under the.
Yeah. Well, we can't propose a rule on anything that we wouldn't have it. Yeah.
I understand. I think there's a disagreement of whether or not.
Well, we can talk about it. I'm happy to talk about it.
All right, I appreciate that. I have another question, but I'm down to 10 seconds, and I know I won't get it out. I will submit it to you for the record.
Sure.
Thank you. I yield back.
Gentleman yields back. Next, we have the gentleman from Texas, Mr. Green, for 5 minutes.
Thank you, Mr. Chairman. I thank the ranking member as well, who's not here at the time, but I also thank Ms. Garcia. I thank you for appearing today, sir. It is my belief that if we did not have the CFPB, we would need to create it. And what I'd like to do is explore some of the rationale for my contention. The staff has done an excellent job in providing intelligence. There's an indication that the agency has required financial firms that violate the law to pay more than $4.1 billion in civil penalties. As a former litigator, I understand the difference between a class action and a small action. What would these persons have to do, if not but for the CFPB, to collect this amount in penalties? What would they have to do without the CFPB?
Yeah, I mean, we have obtained, I believe, about $20 billion in forfeitures. There's no way that people would have been able to get all of this on their own. And in some ways, Congressman, they may not even known about the error or the mischarge. We have been using our complaints and sometimes can see the trends that it's not just 30 or 40, but it's 30 or 40,000. And I think we've had maybe tens of millions of people who've directly benefited from those. And look, we should want a marketplace where people are playing by the rules. And we try and help firms that do, but where they don't, we do have to take action.
Well, I'm proud that you do. Let's explore one additional area, illegal discrimination. We found that a certain bank, no need to mention the name, discriminated and was ordered to pay $25.9 million. This type of litigation usually is long-term, meaning it would be 3 to 5 years. This is what the consumer would have to suffer, just the time alone. And then to find a lawyer who would do this for an individual, you would have to have some deep pockets. Explain, if you would, as tersely as you like, why it's so important that you engage in these illegal discrimination actions.
Many times people wouldn't even know they were the victim of it. In the case you mentioned, those individuals were given fake reasons why they were denied, but in reality it was because they were Armenian American. They wouldn't have even known to do it. And so we got to make sure that we're detecting it and taking action.
Well, I started with the premise that if we didn't have the CFPB, we would need to create it. Sadly, this Congress would never do it. thank God we have it now, because we couldn't get it if we didn't have it. I yield back the balance of my time.
Gentleman yields back. We now go to the gentlewoman from California, Ms. Kim.
Thank you, and Director Chopra, thank you for being with us today. From the inception, the way CFPB was designed disregarded longstanding checks and balances. Under our Constitution, no one agency or person shall have absolute power to do as they please. Even the president is accountable to Congress and to the power of the purse. And the CFPB should not be the exception to longstanding constitutional rules. I think we agree on that. And I do agree with the mission that consumers must be protected from bad actors. The CFPB, in the name of consumer protection, is being used to divert the public's attention from the real challenges faced by individuals and families. And the CFPB under your watch, Mr. Chopra, has not addressed the root causes of indebtedness, of poor economic conditions for millions of Americans. And in your testimony, you highlight that for the first time ever, credit card debt eclipsed $2 trillion last year since CFPB. And you also mentioned the cost of high interest rates for consumers, but unfortunately, you don't mention inflation once in your testimony. You know, you are a member of FSOC, and so you should have been privy to discussions on how fiscal expansionary measures fueled inflation. So if you recall, everyone in the Biden administration was stating that inflation is transitory, but when in fact we all know that it wasn't. So why did you fail to mention inflation in your testimony?
Certainly higher cost of goods. I think I specifically mentioned examples of it. I'm happy to look back at it. In the examples of higher vehicle prices, there's certainly issues with higher home prices. Of course, prices and the rate environment, we do see both as being drivers. The rate environment, I think, has also, as mentioned by one of your colleagues, dramatically increased the price of new mortgage origination. So they're both certainly something we think about, and decomposing it in consumer financial products.
Thank you. You know, since consumers have to pay more for goods and services as you pay, would you agree that inflation played a role in increasing indebtedness to Americans?
Well, so if you look at the amount of household debt relative to net worth, you know, we can share with you the trend lines, but I think it's not our job to really look at, you know, what exactly is happening with respect to each individual good. But we, of course, know that when there are higher prices, when there are higher rates, that is going to affect people, and certainly the Federal Reserve Board.
Thank you.
Is the one
I
that
mentioned that
administers
because, you
monetary
know, we
policy.
had a peak of 9.1% inflation in 2022, I think around June, and that was the highest rate in 40 years. So I just wanted to point that out. But I know in respect to the, I know Chairman McHenry mentioned this earlier, and I share with his concern because back in August last year, or this year, I led a letter with Chairman of the Financial Institutions Chairman, Andy Barr, and there were 17 of my colleagues that sent a letter voicing our concerns regarding the announcement of the informal dialogue between CFPB and the European Commission. And in that letter, we specifically asked the CFPB to brief this committee. So I want to ask you again, will you commit to briefing this committee? Because we want to ensure that the EU is not exporting their financial laws and regulations in the United States.
Well, certainly, let me be clear. We're not cutting and pasting anything from there. We're having a series of meetings, because many of the issues, particularly...
I just need your commitment, because we haven't gotten the briefing
we
that we
face
asked
some
for.
serious global threats when it comes to some of the issues, particularly from bad actors based in China and Russia. And I do think that we need some global cooperation on this. Yes, we will brief you, but we are having meetings with them.
And then we can have that further conversation.
We're having
when you
meetings
come
with
and
them
brief us.
because there are some
So let me
very
reclaim my
serious
time,
issues.
because I do want to put in another question regarding the CFPB's SBRIFA outline. because on that, FCRA proposal raised concerns about legal versus factual disputes, and there is considerable case law and supervision guidance around factual disputes because those questions can be determined by reinvestigation. So, the resolution of a legal dispute depends upon information that is generally not reported to a consumer reporting agency. So how could Credit Bureau make a determination on a legal matter?
Mr. Chairman, can I respond?
Gentle lady is out of time.
We'll answer for the record.
We can get that in writing, I'm sure. What we're going to do is, because there's an open roll call going on right now, we're going to go to Congressman Flood, and then we're going to recess. We have 4 more members, but it should be very quickly because there's only 2 votes, and then we will come back in and finish with those 4 members. So next, we'll recognize the gentleman from Nebraska, Mr. Flood.
Thank you to the very capable chairman from Wisconsin. Mr. Chopra, I'd like to focus on the CFPB's recent rulemaking for larger participants in the market of digital consumer payments. This rulemaking covers a lot of ground, from third-party platforms used in small businesses across the country to digital asset wallets. Let's start with the implications for digital assets. When describing the supervisory authority that the Bureau's larger participant rulemaking would give to the CFPB, there is a footnote explaining, and it says, quote, "The CFPB's supervisory authority is not limited to the products or services that qualified the person for supervision, but also includes other activities," end quote. In my view, this footnote signals that the rulemaking will cover far more than the, quote, "general use digital consumer payment applications," end quote. Can you comment on the CFPB's intentions surrounding the scope of this rulemaking?
So I wouldn't misread that. We are looking to make sure there's a level playing field between the banks and credit unions that offer these services and the large non-banks. We already have enforcement authority over all of these entities that would be covered. It wouldn't create any kind of new jurisdiction, but what we're doing is going through the rulemaking process to establish for certain larger participants, are they following the law, existing law? We could go through that process by, an enforcement investigation. That's more adversarial. I think this is a little bit more of a way to make sure that there are not harms, given some of them really are touching tens of millions of customers. But I think I hear the concern, which is kind of going outside of the jurisdiction, but we can only supervise and enforce the laws that Congress has specifically designated for.
Well, given that the rule does not cover some digital asset transactions, like an investor purchasing Bitcoin through a brokerage account, but does cover others, how would the CFPB distinguish between the different types of transactions conducted by the same digital asset wallet?
Yeah, so we're going to have to deal with that. I think most of what we're going to be doing is focused on ones where it's really consumer payments. I think we're trying, if in as much that they're doing 2 different activities, we have a lot of familiarity how to do this. Many of our banks, they have broker-dealers affiliated with them. They have commercial businesses that we don't cover. So when we do an examination, we explain we're covering the activities under federal consumer financial protection.
So do you think the CFPB has Regulation E authority over transactions using a digital asset like a stablecoin to purchase a consumer good or service?
Well, so part of it, the Electronic Fund Transfer Act covers the transfer of funds. There's certain exceptions for when it is for trading of securities. I think there's other exceptions there. Overall, when you have a consumer payment for household use, I think the case law would suggest that is covered, but we're collecting comment on this just to make sure, and we've been pretty judicious on this point. I've raised with Chairman McHenry and others that, in as much that you all enact anything, we will need to make sure that it is well reflected.
I'd like to quickly switch gears and discuss some of the non-digital asset implications of the rule. Given that third-party payment processing tools are popular among small businesses, how can you be sure that this rule wouldn't result in some of the cost of compliance being passed down to these small businesses?
Well, the rule proposes only for larger participants. So we proposed a threshold for which we're getting comment on. So it's really not supposed to implicate small businesses. And it's really focused on those consumer payments. So I will keep my eye out for that. But again, there's not any kind of new authority. We currently have enforcement and other authorities over these firms already.
I appreciate that. You know, the cost-benefit analysis in this rule states that the Bureau lacks sufficient information to predict how compliance costs would be, quote, borne by providers or passed on to the consumers, end quote. However, you certified that the proposed rule would not have significant impacts on small entities, and therefore the rule wouldn't need to go through the small business panel process. So we've got 20 seconds left. Real quickly, how can you assert the rule will not have an effect on small businesses if the analysis fails to even attempt to weigh the rule's compliance costs?
I think the proposal exempts small business.
Okay, I will look at that. Thank you, Mr. Chairman.
And I'll let you know if it's something different.
Thank you.
Gentleman yields back. We will recess to the call of the chair.